Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, March 10th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important for next week, and update. Well, we're going to review what's left of the 21 over 21 leaders list. A lot of them broken along with the indexes due to the bank contagion over the last 2 days. We'll dig into the charts and see what we can see. State of the market, change it to correction yesterday. Second close below the 200-day moving average and closing the week more than 1% under the 200-day moving average. Anybody that follows us for a long time knows that this is the area where we really kick up the defensiveness and maximize caution because of what bear markets can do to your portfolio. All those bear markets occur under the 200-day moving average, which is where we find ourselves right now. So checking the trend gauge, neutral, red arrow pointing to a bearish slash downtrend. Need to see what transpires this weekend and early next week. What a change. So Jerome Powell testified on Capitol Hill for 2 days this week, Tuesday and Wednesday. Not a single question about uh, anywhere near any kind of bank contagion. It just came out of the blue. The clues were there. They were subtle Tuesday with the big underperformance in the small caps and mid caps, which was tied directly to financials. Wednesday, we had a late rally. Thursday is when it all started coming apart. That's why we've got our short term and our medium term indicators now bearish. Long term, all 5 indexes closed the week under the 200-day moving average. We need to see two weekly closes below to get this to bearish. It's very possible we see a whipsaw next week. I'm seeing some other banks coming out with trying to do capital raises after the close. That's, to me, not a good sign, but at least we're not selling off it more after the close. So what just happened? You pretty much know. Bank contagion, SIVB taken over today by the government. The stock is basically a zero now. It's stopped trading pre-market at around 39, went out yesterday over 100, saw it as low as 30 pre-market. Man, these things can really, it happens a little bit of at a time and then all at once. So that the fears obviously intensifying. I'm seeing reports of companies saying they won't be able to meet their payroll because their money's tied up at SIVB, some Silicon Valley companies. Um, we'll see what plays out over the weekend and into early next week. The thing is that we went from talking about an 80% chance of having a 50-point basis hike to slow the economy to 2 days later wondering if we can even hike at all because of the confidence that's been sucked out of the banking system right now. So unprecedented times we're living through. All 5 moving averages closed below the 200-day moving average. Here were the numbers on the day. Uh, our six growth ETF composite down 2.82%, S&P 500 down 1.45, NASDAQ 100 down 1.4, Dow down 1.1, mid caps down 2.8, Russell 2000 small caps down 2.95. So these two areas really hit hard this week. Global 60/40 down 0.35%. Bonds did their job as a safe haven today. Bonds bid up in a major way. Yields coming off because of the money flowing into the safety trade of bonds. In-house GROTECTION, we went very defensive yesterday, kicked it up a notch today, still down 0.37% on the day. We'll get to the tail of the tape in the 21 over 21 list right now as we get right into what we do here at Revere, and it's all about protecting you from these types of losses. All of these occur under the 200-day moving average. We got 6% above the 200-day on this most recent rally. During bull markets, we usually top about 12% above. And then the question is, how much lower are we going to go below the 200-day moving average? Here are the averages of last bear markets going all the way back to 1968 to 1970. The severe ones highlighted last year, down 27.5%. We're 8% off of the highs now. So we're approaching. I try to set expectations for the way we manage portfolios in different types of markets. So we're on the edge of mild correction and moderate correction, down like 7.9%, 7.8% off of the high. We're very much defensive right now. Normally, this correction doesn't get you under the 200-day moving average, but these aren't normal times. We only got 6% back above, coming off of the bear market. So between mild and moderate correction right now. If the market if the market spikes back up, we're going to see underperformance because it's coming off of the correction into the early recovery. If this is just a shakeout, if Jerome Powell can somehow wave his magic wand and bring confidence back into the financial markets next week, which is a pretty tall order. But if he did, he'd be having to go against um, everything that they've been talking about doing as far as getting inflation under control. So, maybe they raise the FDIC limit from 250,000 up, and that inspires confidence. I don't know, but he's got a tough job ahead of him, and the word contagion does not get thrown around lightly, but that's what a lot of stocks are acting like, and certainly several sectors. And we'll see what next week brings. We'll go through the tail of the tape and show you our portfolio changes this week. But you can see here the 2 harsh days of the sell-off puts us 2% below the 200-day moving average. Let's look at a weekly chart here. Down 4.6% on the week. So a big outside bearish reversal, meaning we made higher highs earlier in the week and lower lows by the end of the week. Let's go to a 5-minute chart, and you can see here uh, this mid-morning rally made everybody think that, hey, maybe this is just no big deal. We were up about 1/3 of a percent, 1/4 of a percent at one time. And then here was the dagger in the heart, going from 39.34 all the way down to 38.46, over 2%. In a couple of hours. 2 bounces got us up to 38.85 before we folded. This 38.80 to 38.90 area was kind of a point of control all day. It acted as support. Look at this perfect head and shoulders that formed on the 5-minute chart here. When that finally gave way, which is 38.86-ish, we broke down to the downside, then coming back up. What I say, 38.86? Where'd we stop on that rally? 38.86 right here. So right now that's a big level. The first level that we need to reclaim if anything bullish is going to occur next week. So 38.86 on the S&P 500, and on the downside, this 38.50-ish level. We just undercut it for a 1 5-minute candle here today. So 38.50 to the downside. When we pulled back later in the day, the low was right at 38.50. So we've got a tight range here, 38.50 to 38.86. Let's see where we open up Monday, above it, below it, or inside it. And then, of course, we got to see the reaction to that initial opening. Friday night futures opening. I mean, 50-50 shot. We could be up 2% or down 2%. Sunday night when the futures open back up at 6 o'clock Eastern time. So there's our break of the 200-day moving average on the S&P 500. Let's go to the NASDAQ 100 next. We held it a couple of times intraday, bounced here, and then trying to reclaim it, we kind of failed. And then you can see where we closed beneath the 50 and the 200, which are basically stacked on top of each other. This one's the closest to the 200-day moving average. Relative strength this week on the NASDAQ 100. Dow Jones Industrial Average, more relative strength today, down 1.1%. Yesterday down 1.7%, but a clear break of the 200-day moving average here. In fact, closing below that 32,000 level. Now the two that led and then just got totally taken apart, starting with big underperformance on Tuesday. Just looks like a blip here, and then holding the 50-day moving average was a way to make people think that there was really no big deal going on. We bounced right where we should have. It was logical support, but then giving way 2.41 yesterday, 2.8 today. On the week, mid caps down 7.4%, basically sitting just below the 200-day moving average. And then small caps, same situation. Underperformance early in the week. Wednesday, undercut and reclaim the 50 just the way you would want it to, but then down 2.8% yesterday, 2.9% today. 8% on the week, clear break of all the moving averages. The reason is there are a lot of regional financials in the mid and small cap indexes, and those are the ones that are taking it on the chin. So basically, SIVB, a bank run, they loaded up with a bunch of securities uh, during COVID, bunch of money coming flowing into them because the government was handing money out. They bought a bunch of bonds paying 1.8%, bunch of, and then the quick rise in interest rates, the Fed raising them so that you could get 1 to 2 year interest T-bills around 5%. A lot of money sucked out of the bank into the T-bills, and then they had to raise capital because of the withdrawals when they had to sell their bonds that were yielding 1.8%. They took a massive loss, a $1.8 billion loss on them, and that's why they had to say that they needed to raise capital. But in order to be liquid to meet their withdrawals, they had to sell the bonds, and that started the run on the bank. And by midday, the bank was insolvent. Happens that quick. So RSP, let's go there. First of all, equal weighted, down worse than market cap weighted. So some money being hidden in these large cap tech stocks because, well, they do have pretty solid financials. RSP down 2.1%, QQEW down 1.72% versus 1.4 for the NASDAQ 100, still holding the 200-day moving average. Here is the dollar. Dollar down. Normally that helps stocks. Dollar didn't matter today. Bounced at the 21-day moving average, down 0.63%. Let's look at a chart. See how tight it was yesterday after the gap down. Another gap down today, and pretty much closing where it opened. But the focus isn't on the dollar anymore, and the technicals and the intermarket correlations of the dollar when there's just bigger fish to fry right now. Let's look at the VIX. Day two of the big pop. In fact, the VIX all the way up to almost 29 on the day, finishing well off the highs, back under 25, but it's above all the key moving averages. Let's switch to bonds and we'll start with TLT. Huge move up today in the price, meaning big move down in the yields. So this island bottom on the TLT, which corresponds to an island top on the TYX 30-year bond, still intact, but we were thinking that this would help equities, but we certainly weren't counting on a bank contagion to get the bond prices where we needed them to be to help stocks. In fact, we got just the opposite. So TLT up 3.45% on the day. Let's go right to the TYX yield 30-year, down 4% on the day. Here's that lone uh, failed breakout. You know, the old Wall Street saying, from failed moves come fast moves in the opposite direction. And you certainly saw that this week, big gap down on yields. And in this case, it's just because of money flowing into treasuries. But this isn't what Powell wants. He wants interest rates higher, not lower. So uh, that's not helping the economy, but from an interest rate standpoint, but a contagion will certainly hurt the economy and slow things down too. So He's kind of between a rock and a hard place here. Let's look at junk bonds. Basically closed flat on the day, and that's actually not good. Although you could say that you would have fully expected them to go lower, junk bonds to go lower, but them just holding steady, that means that um, their yields ended up being steady as opposed to the yields going much lower on corporate bonds and on treasury bonds and corporate bonds. Let's check corporate bonds. LQD up quite a bit, which means their yields were down. Remember, the difference between JNK and LQD is that these are investment grade bonds. So flocking to people wanting return of their money, not as much as return on their money. Broad bond index BND up 1.2, meaning yields all in all down across the board. Let's flip to gold with the dollar being weak and this being a safe haven. You got the expected move up 2% into, so we had been talking about the rally in gold that looked like it completely came undone because of the strength in the dollar. The dollar gave it up the last 2 days, and we actually ended up making a higher high this week on gold. GDX, gold stocks finished at the bottom of the range on the day, but still up 2%. Tried to get above the 200-day moving average and didn't. In this case, gold, the gold chart looking much better than the GDX chart. SLV silver up 2% on the day, still closing near the bottom of its range. And Bitcoin BITO down 1% on the day. The big move down on this was yesterday. Not much more selling today on the Bitcoin futures. So let's get to the tail of the tape now. Correction, obviously. Fear and greed is now in the extreme fear category at a 24. We're working under the bear case as that 3.9 line in the sand, or we broke on 3.9 the line in the sand from the 3.2 low, which is where we bounced at the 200-day moving average. When that happened, we got very defensive yesterday and even more so today. The NFP, the payroll, at the beginning of the week, everybody was looking at the jobs report. It just ended up being an afterthought. The data came in mixed, where more jobs were created than were expected, but wage growth was lower. The initial result was that we went from a third of a percent loss on the futures to a third of a percent gain on the futures, but we topped pre-market right at 39.40, which happens to be the 200-day moving average. And then we reversed by the open on the bank contagion fears. In fact, we opened at 39.12, and then we just seesawed, as I showed on the chart before. Breakout to the upside, big failure, 2% move, couple of bounces, 38.50 looking as support, 38 and 86-ish right here looking as resistance, and then above there, that 39.40 200-day moving average, which is now flat. Again, we went from gaining $1 yesterday to losing that dollar today, and these lower prices won't help that. Expectations negative as long as we're under the 200-day moving average. Day 2 down today, a big day 2 down. Again, a bounce wouldn't surprise me, but an oversold bounce is not the same as a recovery. This is our 4th day below the 80 EMA and the 21 EMA. We use these as a risk-off signal, plain and simple, as if we really needed anything else other than all the red on the screen to tell us what to do. The only things up today, bond prices, gold, and silver stocks, 11 out of 11 sectors down. Staples, the defensive, down the least, but still down. These really got hit. Biotech, banks, real estate, software, and solar. We bought a bunch of T-bills today in-house. Sold TBT, talked about doing that last night. Sold NVIDIA for break even when it pulled back. We trimmed our best acting stocks back to about 2%, First Solar, TMDX, and ANET, and effectively put our exposure from 20% of the S&P to just 4% of the S&P. So get a big bounce up. Early next week, we're going to underperform, but we outperform by over 2.5% this week. So it's kind of built into the process that you get alpha with the crisis, and when the crisis gets averted at the very beginning, if it gets averted, we'll take a little bit of a loss. But remember, uh, we protect the downside first here at Revere. Bottom line, SIVB contagion fears intensify. All indexes below the 200-day moving average. Let's get now to the 21 over 21 list. And this is sorted by how long these stocks have been on the list. And there's a bunch of them that are going to come off, and we're going to do it live. We're going to go through everything. And then some added from my alternate list that are going to end up in here by the end of the reviewing of this video. Iridium, we sold it this week below the 21, 5 below, clear break, sitting on the 50-day moving average, break below. GE continues to look good. Big gap up yesterday as they reaffirmed their numbers inside day today. Revance, we got stopped out of this yesterday, big break below the 50-day moving average today. Tesla sold the rest of this yesterday, bounced at the 50-day moving average today. AI broke the, look at this move up on earnings, up 34%, gave it all back and then some all this week. Terrible reversal. That just means people are just, this is like a Wall Street bets trade, not a bunch of funds piling into it. Apparently, that's what that action tells me. Closed below the 21, also coming off the list. Dynatrace broke down very clearly, coming off the list. ELF, strong for a while, can't resist a bank run, closing below the 21, also coming off the list. ACLS, very strong. Not the last 2 days, though. Failed breakout, resulting in a close below the 21. That's just barely below the 21. I'm going to keep that on here. American Express, clear break below the 21. That's coming off. NVIDIA, we stopped for break even, still holding the 21 though. ALGM, double day pullback, still above the 21. Airbnb, had enough of this stock. Second close below the 21. We got stopped on our last shares yesterday. GFS closed below the 21 by how much? 1.3%. That's coming off. TMDX closed below the 21, still holding the shares that we bought back in here. The gain, obviously, a lot of it has gone. The hot money that came into it late up here, getting stopped out, closed below the 21. It's going to come off the list, but I'm going to leave it on here since we still own it for now. ANET took some profits on this today. Got to lock in some profits in this environment, but pulled back, still above the 8. True leader, one of the great survivors of this. Net, clear break of the 21 and the 50, coming off the list. Palo Alto, up today, relative strength at a new high, still holding it, and holding the 21, quite obviously. SMCI, gonna leave it on, just barely broke the 21. First Solar, sold a third of it today to lock in the gains. Perfect volume patterns on this. Note the volume on the way up the last 2 days with the sell-off, not even above average volume, still above the ADMA. Definitely one of the top 5 stocks in the market. Mercado Libre, break of the 21. SJB, short junk bonds. This may end up being something or it may end up being nothing, but we put it on here based on what's going on in the bond market. Sarepta pulling back after its earnings gap up, but some strength above the 21. Lantheus. So these now are stocks that actually were added when I was going through during the day, starting with SJB. SJB, Sarepta added above the 21, Lantheus added above the 21. Shift 4 payments bounced at the 21 today. Nice reaction to earnings with this above the 21, added. Axon holding up since its earnings move, added. OKTA holding the 21, software security, good group, added. GE Healthcare continues to be a leader. All pullbacks have been contained by the 21, so we added it. CDNS bounced at the 21, acting great. STM right on the 21, and Scorpio Tankers sitting right on the 21. So that's 19. We still got basically 19 stocks. 3 of them may be questionable, but we'll rebuild it. The strength is revealed in the pullback, and if these are still above the 21, these are certainly stocks to keep an eye on if this contagion passes quickly, if confidence comes back into the market, if Jay Powell can do something. We got CPI on Tuesday. We'll see what happens then. And we've got the FOMC in a week and a half. So a lot coming down the pike, and we take it day by day, but for now, being under the 200-day moving average with the fears that are out there, uh, discretion the better part of valor. That's going to wrap it. So as always, love to hear from you. Don at RevereAsset.com. My partner Dan Stewart, Dan at RevereAsset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Always remember, it's not how much you make in the markets, it's how much of that you can keep. That's particularly critical under the 200-day moving average where we are right now. We still own some of the best stocks, 4 of the best, in fact. And we'll see one of them finish positive today in a very red market. The other 2 barely down, TMDX, the 4th one. We've got big gains in it from the pre-earnings gap, but it gave up most of that gap, so we had to trim the buys that were underwater. Trimmed a lot in the portfolio, and the result is we're just have the equivalent of hardly any exposure to the market, and we'll see what next week brings. And with that, I will wrap up the week ending March 10th. This is Don Vandenbord telling it like it is. Nothing but the facts here at Revere. Thanks for listening and have a great weekend.